To everyone for joining. I know that I'm the only thing standing between you and drinks right now, so I'm going to try to keep it as engaging as possible, but also fairly quick. Kicking things right off. So CIGAM, how's our investment performance been? We took a look at 3- and 5-year performance ranking by asset class. So you have balanced fixed income and equities. Pretty remarkable. So we have 16 Lipper awards, 9 of which are for mutual funds, 7 are for ETFs, 35 fund grade A+ awards. So these are both the highest among Canadian asset managers. So pretty remarkable. And sorry, I'll go back to the slide for just one moment. When we're looking at the top quartile, 83% over a 5-year for fixed income. So again, quite a remarkable performance, and we're very proud of that. But taking a look quickly at macro, I'm going to try to walk you through what we've seen in 2024, what we're expecting in 2025. What happened in 24? What surprised us? What didn't? How does it set us up for 25? How are our funds positioned for it? And the strategies that we're going to be talking about today. We're going to wrap it up quickly at the end. But key themes for 2024. So started off 2024, had 2 regional wars ongoing. You still had Russia and Ukraine. You had the turmoil happening in the Middle East as well. But despite those global tensions, markets showed remarkable resilience, had really strong performance. So over here, you see major asset class returns in 2024. Those blue bars here are historical ranges over the past 20 years or so. That yellow bar here, mostly in the positive, are what we saw in 2024. So not historical outperformance, not historical returns, still within the bands that we've seen over the last 20 years, but still very resilient. Inflation eased over the course of 2024. I'm going to focus on North America for a second, on US and on Canada. So US started 2024 CPI inflation measure was at 3.4%. Now, latest rate as of December, 2.9%, so improving, right, down about 0.5%. In Canada, doing much better, started off similar area to where the US was, but we're now at 1.8%. There's a bit more concerns for the Canadian economy, broadly in terms of growth, but inflation, we're within the Bank of Canada's target. So Bank of Canada's targeting a range of 1% to 3%, ideally that 2%, and we're pretty much right there. In terms of rate cuts, what have we seen over the course of 2024? So you had the Bank of Canada kicking it off. They started cutting in June. They delivered 175 basis points of rate cuts over the course of 2024. The US lagged a bit. So we kicked off, we had the Powell pivot. So December 2023, Fed Chair Jerome Powell came out and said, our next move is going to be a cut. We're no longer in a hiking cycle. What'd the market do? Got ahead of itself, as the market sometimes does. When we started off 2024, January, market said, over the course of 2024, Fed futures, what we're pricing in, 6 cuts. That seemed, overly optimistic. It turned out to be overly optimistic. What happened was over the course of the first quarter, we had a bout of inflation. And that became apparent, over January, February, March data that we got for inflation in the US. We saw that ticking up, not in the same trajectory, not moving towards the Fed's 2% target. There was a period of time in April where they actually thought maybe the next move by the Federal Reserve is going to be a hike. Then obviously that did not happen. September, we got that jumbo-sized 50 basis point cut. But really what I'm trying to say is that macro indicators or economic indicators, the macroeconomy has a shifting narrative, shifting stories. Being tactical, being active is very important, especially when you have exposure to fixed income. 10-year yields, I want to talk about that for a moment. So what are 10-year treasuries doing? Something very interesting, something very different from the last 6 cutting cycles that we've seen. So starting in September when the Fed first cut, typically what we see is that 10-year yields start to shift down as the cutting cycle starts. They're actually up about 100 basis points relative to when the Fed started. Now that's, an amalgamation of several things. We started pricing in a red sweep, so that really factored into things, but it's behaving a bit differently. So again, highlighting the importance of staying tactical, looking back to 2024 on what happened, keeping that in mind, but setting the expectations also for 25. We're looking at key themes for 2025. So again, I touched on the fact that inflation in the US surprised to the upside in the first quarter of 2024, but that's kind of been coming down. key theme, I saw an acronym and I sent it to Shola from my team right over there. But Trump stands for tariff. Taxes and tariffs are regulations. U, undocumented and migrants, and P, protectionism. So lots going on, lots on the go, lots to look at for 2025. He's going to keep things interesting for us. But again, setting the stage for 2025 opportunities. I talked about it. Active management, really important. We're transitioning from the inflation focus, the inflation concern focus that we had of being, at that 3.5% inflation rate to start off 2024, coming off the bout of inflation that we had during COVID. It's really important to look at growth-oriented opportunities, sector-specific trends. I'm not going to touch on it today, but we had a slide that we talked about. We had a roadshow. I put up about 5 credit solutions, usually show of hands, fixed income. Who do you think, what fund do you think achieved, 7% or more? Got a few hands, 9%, no one raised their hand. And then I say, only one fund got 9%. The rest were actually 11 to 14%. So remarkable year. Best time to invest in fixed income was really starting in August 2023 or so. But the second best time is now. We still think there's a lot of money to be made. You just have to be tactical in terms of what sectors you're exposed to, in terms of, shifts in asset mix and staying active. Strategic goal setting. So it's important really to balance the risk between volatility and valuations and then opportunities that we see. That's within the credit markets, within investment grade, within high yield, and also for sovereign government debt, so within rates. And then we're prepared for change. So Trump 2.0, Canada election. This is a slide that's a few weeks old, but we're probably going to get that the first week of May. And we're going to get, a lot of changes happening, both in the U.S. stateside and on our side of the border. Just want to touch on the fact of, the short-term volatility that we've seen over the course of 2025. So January 10th, we had employment figures come out of the U.S. and of Canada. Really strong employment figures. Now, 1 month does not make a trend. So if you take a step back to look at, what happened over the course of several months, 3-6 months rolling averages. But the market, again, overreacted. So we got for, market pricing in after employment in the US, 29 basis points of rate cuts. So that's just over 125 basis point rate cuts priced by the market. Now, 2 weeks later, about 40 basis points of rate cuts. We think really there's going to be about 1 to 2 rate cuts happening in the US over the course of 2025. Canada expectations are for 57 basis points of rate cuts. So again, between 2 to 3 rate cuts are probably going to take place in Canada by the end of the year. Just touching on the slide though here for a moment, just in terms of the divergence between CPI in inflation since the start of 2024. This actually goes to the start of 2022. But if we're looking since the start of 2024, that's when the divergence between Canada and the US grew. And that's what I touched on earlier on, just talking about how the US has been a little bit more stuck. They've come down about 0.5%, about 50 basis points from during 2024. Canada, much more so. We're, at around that 1.8 area. Global easing cycle underway. So we had 7 of the world's 10 major developed market central banks cut over the course of 2024. Right now, only Australia and Norway are still on hold. Japan is on a hiking cycle. So they have their whole structural issues that they face that are very different to what's happening in North America, what's happening in the US and in Canada. Next week, so January 29th, that's Wednesday, you have the Bank of Canada announcing their decision in the morning, and then the Federal Reserve announcing their decision in the afternoon. It's very interesting in 25, about 3 or 4 dates that are in line, same day, Bank of Canada and the Fed. So expect an update from CIGAM there. What happened to currency? So interest rates are a main driver to currency. You can think of it as, you have $1. Do you want to put it in a US piggy bank or in a Canadian piggy bank? If, the Canadian interest rates are moving lower, Canadian dollar depreciates more, right? You run the risk also of importing inflation to some degree. So 2024, we started the year, dollar CAD was 134. We're at around 144 now. So first leg of it was really on the back of Canadian dollar weakness specifically. The second leg of it, interestingly, when you look at a basket of currencies, was much more a US story, much more Trump. Canada actually performed quite well. So Canada was, I think, the second best performer after the US, but something that we're taking a look at. Living expenses, something that you probably hear quite often about. This is an old chart, I think. I think the data is from 2022, still holds though. Looking at, people that rent, people that own a mortgage, and people that own without a mortgage. What do they feel about how meeting financial commitments without difficulty? On a downward trajectory for everyone, for those that rent, for those that own with or without a mortgage. They're finding it harder and harder to meet financial commitments without difficulty. What about borrowing to meet daily needs? Also ticking up. So more and more people looking at borrowing to meet daily needs. This probably improved a little bit, but not so much. Absolute price levels are still high, right? That's a problem. It's a fiscal problem that governments are faced with. Even when we're looking at cutting cycles, people day to day still have high price level that they need to contend with. What about mortgage renewals? We're looking at 2025 and 2026, and we took a look at a 5-year fixed rate mortgage renewal. It's getting a bit better, relative especially to what the Bank of Canada estimated it would be in terms of the renewal upcharge. So they expected back in April that in 2025, anyone renewing a 5-year fixed mortgage would have a monthly payment that was 23% higher, 2026, 26% higher, come down a bit. We started off expecting about 4 cuts in Canada over the course of 2024. We got 175 basis points of cuts. So, the increase is being revised to 18% for 25 and 19% for 26. Better, but still not great, right? Still absolute high price levels, and people are feeling stretched. I want to talk about the divergence in terms of labor in Canada, between Canada and the US. And this is quite interesting. So we had a surge of immigration happening in Canada, 22, 23. What happened was net change in employment, that blue line, did not keep up with the population growth. What happens? Unemployment rate goes up. And you see that over here. That red line is Canada. Blue line is the US. Canada, latest, 6.7%. US is 4.1%. Not apples to apples. They actually capture the working age population differently. There's a bit of tweak. So it's not exactly the same. But when you look at the trajectory of increase in the level of unemployment in Canada versus that of the US, we're in a worse shape relative to our neighbors down south. How's that going to change? I think it's going to improve because the projected growth in population is expected to slow. So this is where we've been so far, the actual line. And the dotted line here, that red line is the projected decrease, the government target. This is what the Bank of Canada assumes in their most recent NPR, and we get an update for that. Monetary policy on Wednesday, when we have the next Bank of Canada meeting. And then this is our projection. There's a bit of a difference here. We think that they accounted, they forecast too much people actually leaving Canada out of their own volition that is actually going to happen. So that is our expectation. So again, less population growth, a bit better for the unemployment rate, also better for productivity. I'm going to touch on that as well. What's happened in terms of when you're looking under the hood, components of real GDP in Canada. You see this red line here, residential investment, that really carried through for the most part. And I feel like everyone's favorite topic in Canada, right? Housing. That's really carried through, was the highest component of GDP. That flipped. Now it's government, that dark blue line. Not great, right? For raising standards of living for GDP. You don't want a country that is growing and being propelled by government investment. I want to tie back to tariffs for one moment. 20% of Canadian GDP is tied to US exports, and that's 75% of Canadian exports are heading US bound. So that's something to keep in mind as well as we're looking at the absolute level of GDP, as we're thinking about concerns in terms of exports and what happens there with the tariff threats that are looming. How am I doing for time, by the way? Doing okay? Okay, 8 minutes. I won't go too much over so we can get to the bar. Lagging business investment led to challenged productivity. And this is both in Canada and in the US. It's a new business friendly government that would come in May, could change that. So take a look here. Real business gross fixed capital formation lagging. Canada, not the most hospitable place for foreign investment. Not really supportive of the innovation that we really have. We are really bullish on the Canadian economy from the perspective of innovation. We just need to have a government that enables that. So that's something that we're taking a look at quite a bit, and hasn't really been as hospitable to investment and to that growth in Canada. That's the gray line there that's kind of been hovering fairly in place for the last 10 years or so. When we look at labor productivity, so that's real GDP per hour worked in the US, going up fairly steadily, right? Their productivity measures in the US are doing well. When we're looking at it in Canada, we peaked at around 2022, and it's been moving lower and lower. We're probably closer to the bottom of the pack in terms of the G7 when we're looking at productivity measures. Back in March 2024, so just under a year ago, Deputy Governor of the Bank of Canada, Carolyn Rogers, actually dubbed it a state of emergency. So she said Canadian productivity is in a state of emergency in Canada. There needs to be monetary policy that supports it. There also needs to be fiscal policy that aids it. And that's really what we're hoping that a new Canadian government, whether liberal or conservative, not taking sides here, would be able to fix that, would be able to make it more hospitable to investment. What about US labor productivity? So we talked a little bit about how it's going up, but I want to touch on something that you've heard from the two AI presentations earlier. But let's take a look historically, going back all the way to 1960, US labor productivity. What were some of the booms, drawbacks? So you had the Reagan years, you had unionization, you had a huge boom from personal computers, bringing those to people's desktops really helped with productivity. But when we narrow in and we look at it over, the last 5 years or so, since early 2020, we're seeing real average weekly earnings. So that's the amount companies pay to their employees, not rising as quickly as labor productivity. And we think this is the early innings of AI. What does that mean? It's supportive for company bottom lines. Part of the reason that we're still bullish on credit, right, on corporate bonds. We think that this gap will keep on increasing. When we're looking back, and this is a question that we get quite often, should I move out of money markets, GICs, HISA? Is now the right time? Was last year the right? Well, last year was the right time, as you heard me say. But we looked back at the last 5 cutting cycles in Canada, and 1-year returns from the point where the Bank of Canada delivered their first rate cut. How did GICs, that blue line, do versus just a regular index of Canadian bonds, which we typically outperform? But you see Canadian bonds outperforming GICs in each one of the previous 5 cutting cycles. What about extending duration? What does that do in a cutting cycle? You extend duration, you add interest rate sensitivity to the portfolio, and you see that here. We had, you have no landing, soft landing, hard landing, what economy we can expect, but with every cut, you see that as you extend duration, as you move closer to that 10-year mark, you increase your sensitivity to movements in the yield curve, right? So you have a hard landing, far from our base case, 150 basis points that's not priced in. 10-year bonds, they rally. They return, total return of 15%. So increasing duration, adding duration, longer duration in your fixed income portfolios, add to interest rate sensitivities in a cutting cycle where you have cuts materializing, additive to returns. Where do we think are the best, or not where do we think, where do we know from our analysis from the past, going back to 1997, where are the best risk-adjusted returns within credit? They're within the highest rated high yield, that's BB, and the lowest rated investment grade, BBB. That's where you see the highest Sharpe ratio, the best risk-adjusted returns. So, for BBB within investment grade space, 0.72. Higher than AAA all the way to single A. In BB, in the BB bucket, so that's within high yield, 1.16. You see that there, the yellow diamond. And we really look at it as, this is companies that are within investment grade in the BBB. You see companies, and we call them post-event companies. What do we mean by that? They've had a leverage event happen. They've been downgraded. They're trying to hang on to that investment grade rating, not to move out of investment grade. They're not doing stupid things with their money, right? They're trying to potentially get upgraded to single A. They're trying to really keep and protect their investment grade rating. Within BB, again, they're trying to not move lower to single A where there's much less liquidity, much higher spread in terms of the credit curve. And they're potentially trying to be a rising star, right? To look at getting upgraded to that BBB area to be an investment grade company. So really we look at it as the best place to achieve returns within the credit space in that bucket. I'm going to touch on active ETFs for a moment. I think this is a very important area to look at. This is specifically, fixed income within Canada. Taking it a step back for a moment, this chart is on Canada, but in the US over 2024, we saw $1.1 trillion of of ETFs, and that's double 583 billion, which was 2023. And the previous record from 2021 was 901 billion in ETF launches. Now, ETF issuers launched 727 strategies, up from 40% in 2023. Pretty remarkable. In Canada, we're seeing growth in active fixed income ETFs. So AUM rising 15% year over year. Performance advantage, so active outperformance on average of about 1.2% relative to the passive counterparts. What do we expect though for 2025? A soft landing still remains our highest probability, highest conviction base case. And in our strategies, we're not swinging for the fences. We are long-term investors and we're playing to the highest probability, highest likelihood scenario. But it is important to be prepared to be tactical because the narrative changes. You have to be opportunistic. After Trump was elected, there was a backup in 10-year yields. We took that opportunity to buy duration, right? To lean into it, to lean into that knee-jerk reaction the market had. Finished the week close to where it started it, interestingly. So active strategies that did buy duration were able to benefit from that. We're able to buy duration at a cheaper rate relative to where the week started and ended. We think that the corporate spread or credit spreads right now are very tight from a historical perspective, but we think it's justified. Corporations have a strong balance sheet. You've heard also from previous presentations that the new administration in the US should be positive for US companies specifically. But we think that it's still important to partner with active specialized managers to be able to uncover the opportunities. It's not a beta trade anymore, much more alpha seeking from this point on in 2025. I want to touch on this chart for a moment. It's something that we've been talking about quite a bit. Morgan Stanley did the legwork for us. So they looked back from 1948 to 2024 to see where are the highest quarterly investment grade excess returns over government bonds relative to where real GDP is within the economy. So we're right now at around 2.6, 2.7%, right within that bucket of GDP being between 1% to 3%. That generates the highest, from a historic look back from 1948 to 2024, generates the highest quarterly investment grade excess returns. And then, just looking forward into 2025, we're looking at budget deficits, a question that we are getting from more and more advisors, and we're tackling, monetary policy acts with long and variable lags. So Canada is being aided by those cuts that are coming in. We're going to get the effects of being a terminal at the highest, the peak rates in both Canada and the US. That's probably only going to trickle through to the economy second to third quarter of 2025. It takes time. And we do think that, China is additive as well. There's early signs of a recovery there, and that's supportive for a global economy with the caveat again that we'll look to see what happens with the tariffs and how they're imposed, how that plays out. But broadly speaking, we're still bullish on returns over the course of 2025. I want to talk very briefly about our process, but I'll probably just highlight, this is the team. So led by Jeff Marshall. Jeff is joining us for drinks at 4 p.m. So come find him. He'd love to chat to you. He's the head of fixed income and lead on private markets. Domestic rates is run by Grant Connor. Global and emerging markets rate, Fernanda Fenton. Investment grade credit is led by John Shaw. High yield credit is now led by Brad Benson. Brad and Jeff have been working together since 2007. And then John and Jeff have been working together since 2006. So team has a lot of history together. And then liquid alternatives is run by Jason Goddard. But really, there's multiple levers that drive return for each of our funds. So duration strategy, we talked a bit about that. Yield curve strategy, flattening and steepening. I know that Steve talked a little bit about yield curve normalization and that disinversion that had happened. Sector weights, so whether it's high yield investment grade, EM, or market security selection within the investment grade, FX exposure, and then cash sleeve allocation. And then, we look at currency as the base for risk return driver, and then we build on that to duration, credit, curve, inflation, and volatility. In terms of the process that happens in investment grade, high yield, global rates, and rates, it's a collaborative process. And then many strategies have people from several teams collaborating on them together. Essentially, it is a bottom up when you're looking at credit at company specific, and then a top down when you take a more macro view, and that's applies more to rates specifically. But I want to talk about strategies for a moment, very quickly, before we wrap things up here. CI Global Unconstrained Bond Fund. This is my personal favorite, and we're not supposed to have them, but this is the first fund I spoke to when I joined. And when I joined, I was asked to talk about a strategy. We were looking at several alternatives. This strategy had just under 40 million, but remarkable performance. And I couldn't figure out why. It was really the reason why it got held back was it launched in 2018 as a private pool, 100K minimum. No one was running out of the gates to delve into the strategy. Since then, it got lowered repeatedly all the way to 5,000. This past July, it got launched as a mutual fund and as an ETF, so virtually no minimum. But it's an all hands on deck approach. So everyone across team fixed income, along with our macroeconomics team, contributes to this strategy. It's a 5-star Morningstar A+ Fund Grade Award and Lipper Award winner for 2024. But it really employs best-in-class security selection, duration construction, and asset allocation. And these are other funds that the PMs that are involved within the strategy have exhibited exactly the best-in-class characteristics described here and do it quite well. In terms of how the portfolio is allocated right now. So as the name suggests, unconstrained, you can have 0% to 100% allocation. Why do you need a fund like that? We found that from the point in time where the PMs have a good idea, and often they're asked to share good ideas, to when they actually, put that idea and structure it together to take it to talk to the IPMs, we go and we talk to wholesalers who talk to you, talking to the end clients. And then, by the way, that allocation gets shifted. That might take 6 to 9 months. That good idea might not be relevant anymore. So this fund lets you sit in the front seat with the PM, and it really gives them the flexibility, the feasibility to allocate across the different asset mix based on what opportunities are out there right now. They do quite a good job of it, as we see from historical performance so far. But the asset mix right now, at the core, the highest allocation is to investment grade, just under 39%, followed by Canada government bonds, which drive really the duration of the fund, and then high yield corporates after that at 23%. Yield is just over 5%. Credit quality is within the investment grade sphere. It's BBB plus. Duration, we're going to talk about how that's been changed, and that's been very tactical, is at 6.2, risk rated low, and available as a mutual fund and as an ETF. It is deep resource, so all 17 members of CIGAM fixed income team contribute to this strategy. I'm not going to take you through too much of this. This is just to show you a river chart of the shifting allocations within the fund, just to visually show you how tactical and active this fund really is. In terms of historical duration shift, so when it made sense to stay short, when the yield curve was inverted, when 2s were yielding a higher rate than 10s, the fund stayed short. There was no reason to extend out the yield curve, right? Stayed short at around that 2-year bucket, much more exposed to credit selectively. But then as it became apparent that the next move by most central banks was going to be a cut, they started to strategically add interest rate exposure, add that interest rate sensitivity, add duration. I talked about what happened right after the US elections. This is something that consistently happens, with the fund. 2024 started at 4 years. We're right now, and we ended 2024 at 6.2 years. In terms of credit quality shifts, it's also been rising. April 2021, where this starts, is really around COVID. So you had a lot of downgrades, you had a lot of issuers that were exposed to consumers that were pulling back. So, that was both a time where you saw upgrades within the market, which is why you see that increasing, but also a time where we've increased allocation to government bonds to add that duration exposure. And really that was a driver behind the credit quality shift higher. The money slide, if you will. How did we do? Remarkably well. So first quartile, top decile since common inception, 3, 4, and 5 year. Highest 5-year Sharpe ratio. We're looking at our competitors, and we listed Mackenzie, Fidelity, Manulife, PIMCO, and RBC there. 5-star Morningstar rated. AUM is around 260 million now, right? So we've been getting about $1 million of inflow to this fund. It's getting a lot of attention in the market, a lot of interest. We still think that this is the best place you can be to be tactical, to be truly unconstrained. Looking at PIMCO, for example, at over 27 billion, really hard to be tactical, to make those shifts when you're that size, right? Really hard to lean into opportunities as you see them. And we really think that, CI Global Unconstrained Bond Fund is the perfect solution to do just that. I'm going to quickly talk about 2 more funds that we have here. Global Investment Grade Class. It is available as a corporate class, also as a mutual fund, co-run by John Shaw and Leanne Angaro. They've been working together since 2006, I believe. Leanne joined a couple of years earlier. She has a track record of over 20 plus years. John Shaw over 30 years. The strategy is primarily investment grade corporate bonds, so almost 66%. Also, you can see here quartile rank, remarkable performance, top decile when we're looking at it since common inception. We had all 6 members of team investment grade contributing to this strategy. Satellite positions within PREX, which have had a remarkable run, over 20% over the course of 2024. Government bonds, which is what we look at to add duration, to add interest rate sensitivity to this fund, and then some high yield exposure as well. The fund always targets staying within that credit quality of A-. So that's always where it aims to sit. Duration is between 4 to 8 years, which is what we have here. And in terms of, what you can expect it, again, investment grade will always remain at its course. So always 40 to 90%. And then government bonds as well as the core asset mix composition of the portfolio. This portfolio is also quite tactical. You're going to get a copy of this presentation. So if you need bedtime material, I highly recommend the river charts in both funds. But they really show you a look under the hood of what the PMs are thinking and then what you can expect them to think, given what the market throws at them. What are going to be the next macro changes? What was their framework that they applied? What they could apply going forward? When we're looking at historical duration shift, so again, quite tactical to where we sit right now at 5.27, and then historical credit shifts, again, targeting that A- rating. So we've been there pretty consistently, apart from like a period of time early on around COVID. In terms of our outlook for investment grade, I think that, the outlook of what happened in 2024 surpassed even John Shaw's expectation for a bullish case. But we still think that 2025 will still see range-bound, rates within the investment grade sphere. So credit spreads are not really expected to blow out. That might be more of a 2026 story, in which case the fund will lower its duration. But at this point, we still think that balance sheets are looking very healthy for investment grade solutions. And we also think that the incoming administration will be additive to performance. So there's no concerns that we have at the moment in terms of spreads. In terms of how the fund did on a 5-year annualized return basis, and we took RBC, Manulife, and Dynamic Solutions here, return topped, and then also, return topped out of the 4 solutions. Standard deviation was higher, probably middle of the pack, but the Sharpe ratio merited it. So again, on a Sharpe ratio basis for a 5-year track record, the strategy performed remarkably well. The last strategy I want to talk about is our global short-term bond fund, launched in July, along the same time that Global Unconstrained Bond Fund repackaged as a mutual fund trust, and as an ETF. But it's run by Leanne Angaro, who covers investment grade, Fernanda Fenton, who covers rates, global rates, and then Darren Aerosmith, who covers high yield. Together, they contribute to the strategy. The strategy itself has AUM of just over 400 million now, tilting closer to its maximum duration of around 2 years at the moment. I think that 1.77 is from the end of December. They've been adding to it since, yielding about 4.3% at the moment, leaning into high yield. We still think that being tactical and leaning into higher, better credit high yield is a great opportunity. I'll take an example from a conversation I had with Darren just recently of how loans, right, a segment of the market that's still benefiting from higher short-term rates, is expected to still do well. right? That's an area that's expected. He's expecting for about a 7% over the course of 2025. So again, adding on to the loan space within the fund, staying very tactical and true to our active management mandates. With that, maybe I'll open it up to any questions, or we will head down to the bar.